Hey everybody, welcome back to another episode of Real Estate on the Rocks. This is JC Ortega. I'm with
Jameson Amros.
and we're missing Oscar Ibarra today, unfortunately. He is in San Diego with his family enjoying some sun and some beach.
But a whale's vagina,
yeah.
I believe is what that's called.
That's a scientific term. I saw it on Wikipedia, so it must be true. But we make up the Metro 5280 home team powered by Fathom Realty.
Yes, sir.
We are currently the 12th largest team in units sold in the state of Colorado.
How many units is that?
Last year was about 146. So we average roughly 130 plus per year. This year we'll be right around the same thing. So.
With a ton of experience too.
Yeah. So we have a lot of agents who are, 18 plus years in the business individually. So together we have a great collection of minds, and we can't wait to share what we have learned or experiencing in the market with you.
Yep.
But first, thank you so much for sticking with us. We had a lot of support and feedback from our first episode.
Yep. Yeah, it was rough. We acknowledge we made some mistakes. Somebody could have had a very bad prediction that's now on the internet that lives forever, and we'll correct that today. But
it's on there.
Podcasts are they're different, right? I mean,
I'm gonna make it as ringtones every time I call him. It's gonna be like
caller ID is just gonna say, "Who's calling? You were wrong." But we're learning, and we appreciate you guys coming along for the ride. It's one of those things where you listen to yourself. It's like listening to yourself on a voicemail, right? Like,
I hate my voice.
I don't sound like that, do I? Do I really sound that terrible? So we appreciate you guys sticking around. We're gonna try and continue to improve every week, and we really appreciate the support everybody's given us. We've gotten some positive feedback, whether that's fake or not, and just wants to make us feel good. We appreciate either way. And every week we're going to try and do something different, try and do something new. And I think our overall goal stays the same, right? We want to educate you guys in the best and most entertaining ways possible so that you guys can navigate the insanity that's happening right now in the housing market, in life. And hopefully bring some smiles. I don't know,
Right now it's a little tough, and I promise not to bang on the table again,
which he just did. So now that his ringtone is going to be bam bam.
As my son was telling me yesterday, Dad, don't bang. It hurts my ears. So this stuff is hard. I've been listening to podcasts for a long time, sports in particular, but it's crazy. I thought it
sounds easy.
Yeah,
it's not.
It's rough. So again, super appreciate the support. It means a lot to us, and we will get better. And hopefully, the content and the entertainment we bring you will add value in some way, shape, or form.
Yeah, and I want to give a shout out to one of our production coordinators, Charles Sardelli. He's also part of a real estate team, but he has a background in video and audio production, has been helping us out. So shout out to Charlie for dealing with us as we try and fumble through this whole podcast world. So thanks, Charlie. Appreciate it. I see you back there.
Absolutely, man. You're the best. So today's topic is going to be a derivative of last week. So as our co-host Jameson Amros alluded to, he is Nostradamus of the week.
Listen, I'm Nostradamus, okay? And here's what happened. I'm going to explain it really quick. We always look at history, right? That's how we look at things and try to predict the future. Every time the Fed has raised the rate, banks have taken it into account, and we haven't seen a spike in mortgage rates. What happened last week is we knew the 75 basis point hike was going to happen. We knew, and everybody priced it in. What we didn't know,
or what Jameson predicted on camera and on tape.
What I predicted was things weren't going to change drastically. What actually happened was things changed drastically. And the reason was because the Fed said, hey, by the way, we got a 75 basis point rate hike, but we're also expecting to do another 125 basis points between now and the end of the year. And that was then priced in by the banks and the mortgage companies that wasn't previously priced in. So I apologize. This is me on air saying I was wrong. And today's episode is to try and talk through some of those fears and sentiments around the rate hike and what it means if you're looking at buying or selling a house.
Which you just experienced was Jameson's wife on a daily basis apologizing for being wrong day after day and her gloating.
Actually, note cards, it's easy, right?
It feels okay. It feels okay.
It does feel good.
So
we'll get through it.
Before we get into all of that, so basically what we're going to talk about today is like rates are higher than we thought. However, there's still creative options out there, and there's things that we can do to alleviate some of this nonsense. And it's not going to be scary. As we move into Halloween,
it's spooky season, baby.
It's not going to be that scary, promise you. So before we get into all that, this is the fun part. This is where we got most of the feedback that people wanted more of the info from.
The alcoholics.
Is our bourbon introduction. So today's bourbon of the week is going to be 1792, 12-year. One of my favorites. I love this one so much. Jameson, what do you know about this thing?
Right now, I mean, I personally know nothing. However, we have something called the internet. It gives us some fun facts. And there's a couple of fun facts I wanted to highlight as far as the 1792 bourbon. So number one, it's 1792 because that highlights the year that Kentucky was initially essentially joined the Union as a state. It was the distillery itself was established in 1879. So if any of you whiskey aficionados are privy to Bardstown, it is actually the oldest distillery in Bardstown, established in 1879. It's a 192-acre facility. That's a lot of whiskey. Like, I could do a lot with 192 acres of whiskey. So we're excited to taste it today. It did win the silver medal in San Francisco in the World Spirit Competition in 2021. And supposedly, and you've had Pappy, I have not. So I'm going to put that out there.
There's a trend here. I
There's a
typically
trend,
have the more
right?
classy bourbons.
Yeah, I listen. We'll talk. That's a different podcast. This is supposedly a good competitor to Pappy at a much cheaper price.
I would agree. This is actually up there with Weller 12.
Okay.
If people are familiar with the Buffalo Trace or the Sazerac line, this is in line with that.
Which, by the way, this is a total side note, but if you guys are on Netflix, one of the better documentaries is the Pappy Van Winkle
so
heist.
good, so funny.
Oh my god,
Yeah.
It is absolutely insane. If you
This
guys
story's nuts.
watch that and understand the depravity that people will go to get good whiskey, this is part of the reason why we do this podcast. So I'm excited to try it. JC's had it before. It's one of his favorites. I've never had it, so if you guys are
it's
at
super
home
good.
following along,
The cool
let's
thing
cheers.
is,
And
what's kind of cool about this one? This was a silver medal in 2021. We talked a little bit about last week, the Smoke Wagon Uncut Unfiltered.
yeah.
That actually won gold. So we haven't had that one yet. We'll probably go that a couple weeks from now.
yeah, I think so.
But
yeah, we have it on the tap.
We're technically going too fast, too hard on the good stuff, but it's okay because you know what? We're still learning. So
We are still learning.
If we're going to be bad at the talking on the internet, we might as well be good at the drinking other good stuff.
Have I told you guys this is going to be a roller coaster ride? Strap in.
Cheers, my friend. So what are your initial thoughts? Woo-wee! Smooth.
Oh, dude, that's so smooth. Oh my god.
Yeah.
Yeah, this is recommended. It's a 96 proof, so
It's a little lighter, but it's aged 12 years,
Yeah.
which is tough, right?
Yeah. So JC, what does 12 years age mean?
This means when you put whiskey in a oak barrel,
Yep.
they're going to char the inside of it, and they're going to store it in a rick house for 12 years.
Okay.
So when you put something in a rick house, which has no air conditioner, no heating, they're just out in the open, the elements are going to heat it. They're going to cool it. Some winters will be colder than others. Some summers hotter than others. The light will hit it. It's going to change the flavor quite a bit over 12 years.
So there's a lot of factors that kind of go into how this whiskey is going to taste after 12 years if it's in a rick house, right? Because it's not a climate controlled
Nope.
environment.
No.
It is susceptible to the elements, susceptible to different factors like cold and heat, wind, and so on and so forth.
And it changes every day.
Kind of similar to the real estate market. Yeah,
What
you
did
think
there.
so?
Like what you did there.
See that?
Yeah. The cool
That's
thing
called
too,
a segue, ladies and gentlemen.
segue. I'm going to finish this up. The other cool thing about this one is because it's 12 years, over time you have a natural evaporation. So what you're drinking is some juice that is very fine, very rare, just like the advice we're about to dawn on you.
Some would call it liquid courage, which is also what we're using to even do this podcast in the first place. So
Speak for yourself, my friend. Speak for yourself. So again, this is fantastic. Like actually, this is kind of a treat.
don't
drink this one
easy.
often, but I am pumped.
Yeah, this is easy to say.
And part of the reason why we wanted to bust open this good one is because this topic is going to be quite sensitive in some ways.
Sure.
It's caused a lot of friction with buyers and sellers, and it's caused fear amongst pretty much all the news outlets out there. Everyone's talking about how we're getting into 2008 and it's going to crash and yeah.
Yeah.
Again, more nonsense, more noise. And again, like not going to say there's not going to be an effect, but ultimately our goal is again to give you the most information that's most relevant to today's climate and market conditions so that you can do the best with what we have to offer. So Jameson, get into rates, man.
Rates, per my prediction, are wrong. Just say that again.
So what were they?
They've
like,
increased, man.
Like last Wednesday when we filmed.
I mean, so here's the easiest way to describe it, right?
What was the number last week?
Every mortgage company has a rate table, right? And that rate table basically dictates, okay, if I'm going to borrow money from this bank and these investors, this is the interest rate I'm going to pay on it. And last week, when we were talking about the Fed rate hike, everybody had priced in, and you were looking around a 6.5, between 6.5, 6.875, somewhere around there, right? And we knew that that was priced in because previously the Fed had said, hey, we're probably going to see a 75 basis point rate hike, which puts upward pressure on mortgage rates, so on and so forth. Well, that rate table now, once the Fed came out and did that, and then also said there was going to be additional rate hikes, basically saying, hey, telegraphing, this is what we're going to do. If you talk to a lender, the current rates that we're at aren't actually on the rate table. So right now, to be completely transparent with you guys, rates are probably around a 7.125 to a 7.6. I think we got quoted earlier today when we were talking to one of our lender partners.
We did hear a 7.6 today.
Yeah, but they're not on the rate table. So what that means is in order to get to a 6.875, there's points that need to be paid. So that will affect closing costs and different things you have to come with out of pocket if you're a buyer. But it's because, the mortgage companies, they don't want to advertise 7% rates. They don't have a rate table. And the second part of that is it's so volatile now that, they want to make sure that they're not changing these tables on a weekly basis because of market sentiment and different things that happen. So right now we're almost north of a 7, I would say.
No, we are
for the first time in, I want to say it's almost a decade, right?
I think it's probably longer than that.
Yeah.
This is my 8th year, and the highest rate I've ever seen previous to this year was 5.75. So this is by far the highest I've ever seen it. But again, it goes to, we talked a little bit last week around like, you can't control yesterday, you can't control tomorrow, but what you can control is today and what you do with the decisions you make. And just, for reference, right, we saw the highest peak, which was on Friday, and it's actually trickled back down today.
Yep.
Actually, I lied. It was Monday that was the highest, but it's trickled back down today. So it's going to be ever changing, and we can't predict that. What we can predict is what we can do with the programs that are available today.
Yep.
And the good news is, like, lenders, just like buyers, just like sellers, they're going to react, and they're going to come up with programs or options or different things that we're going to help everyone achieve what they want to achieve.
Yeah, and I think that's the give and take is, as environments change, people adapt. Right?
100%.
And it's not a bad thing, but we do recognize that there is a negative sentiment to what we would call creative financing.
Yeah, I agree.
Right.
And anytime you say creative, like the first thing that comes to my mind is like shady or awkward or weird or not good. But what we want to talk about today is how to win in our current environment. And there's actually going to be opportunity. In fact,
1,000%.
Still got people under contract this weekend.
Yep.
So let's transition into our first piece of this, which is going to be buy downs. So Jameson, what's a buy down?
So a rate buy down essentially is it's money paid to pay off the interest portion of a loan, right? So when we talk about a buy down, and you guys have probably heard a 2-1 buy down. We've got 3 2-1 buy downs. Essentially what it means is if I can get somebody to pay those interest points, I can then decrease my interest that I pay on my mortgage for a set amount of time.
Yeah, so you're paying money up front to get the rate from what it is currently down to whatever it may be.
Correct.
And there's really 2 types of buy downs.
Yep.
There's a temporary one.
Mm-hmm.
There's a permanent one.
Correct.
So what we want to dive deeper into is what are the benefits. Oh, there's the begging again. Benefits of a buy down that's permanent and a buy down that's temporary.
Yep.
And what are some of the different options?
Yep.
So what right now would you say is more effective for our clients, permanent or temporary?
So the question is, how volatile do you think the market's going to be going forward, right?
Good question.
And I think what we've seen over the last, 5-6 months since June, let's say, it's been very volatile, right? And it's not only volatile because we have inflation. We're dealing with a lot of different just macroeconomic issues throughout the world, whether it's
external too, right? Like there's things not even in the United States that are causing these issues.
Yeah, you're talking the Russia-Ukraine war. You're talking Germany's inflation. Obviously, the dollar is going to drive a lot of what the world economy does, and that's evident that the dollar is as strong as it is currently. But there's a lot of things that are happening outside of our sphere that are affecting rates and different things within our economy. So when you look at it and you say, okay, we know after looking over the last 6 months that rates are going to be volatile. What we want to do is we want to buy as much time as possible from a mortgage rate standpoint to get to a point where we can refinance, so on and so forth. So if you're looking at a 2-1 rate buy down versus a permanent buy down, the 2-1 rate buy down or the 3-1 rate buy down makes a little bit more sense because A, it costs less. B, yes, it's a short-term solution, but it buys us time to get back to an economic standpoint, which would allow us to have lower mortgage rates, aka a recession, which most likely is going to happen, within the next 18 to 24
We're already
months.
there. Like the reporting will be out in a couple of weeks, but let's be honest, we all kind of know we're there.
Yep. Yeah. So basically, what you're battling is if I'm at a, like we just said, right, 7125. I think we just heard from one of our lenders on a 680 credit score,
Best
conventional
possible
loan.
rate on conventional with 10%,
7125,
yeah,
5% down.
Yeah.
Right. So if I do a permanent rate buy down, I may buy down 1/4%, maybe 0.5% on the good day, which will cost me as a buyer $5,000 to $7,000 to $8,000, which gets me to what, 6.5, 6.75, somewhere around there, and I'm locked in for 30 years, right? Versus if I can get a seller to help me out with that based on the fact that the house has been on the market for a while, home prices are continuing to drop a little bit, and I can get down, if it's a 3-1 buy down, I'm talking 3% below what I'm at. So what's 3% below 7,125? It's a 4,125 for the first year, 5,125 for the second year, 6,125 for the third year. So that money allows me to have a cheaper monthly payment for 3 years. And essentially the hope is that as interest rates go back down, you can then refinance into the lower rate for the remainder of the 30-year term versus a permanent buy down. I mean, I bought down the rate. That's great. But if I only bought down to a 6,125, now I'm going to have to refinance in 3 years, pay more money for that refinance. And essentially, I never see that money. It doesn't work for me.
Yeah, I think
we talk about leverage all the time, right?
Yep.
In real estate, we want to maintain leverage. A buy down is the way for buyers right now to maintain leverage in a transaction.
Yeah, and if you break it down by the numbers, which we've talked about quite a bit on this pod, is numbers and numbers and numbers, is like Jameson was saying, the current rate, let's call it 7.25.
Yep.
You buy it down for $7,000,
Mm-hmm.
and it gets down to 6.875.
Yep.
On a $550,000 house, $600,000 house, it's going to save you roughly $50 a month.
Correct.
So if we divide the cost of that by the monthly savings, how much time will it take you to recoup that cost?
Yeah.
And really, the hope is, if after 6 months the rate drops below that, you're going to refinance anyways.
Mm-hmm.
So that means you paid all that money. You only saved, let's call it, 10 months. You saved $500, but you paid $7,000 to get there. You just gave up all that money.
Yeah. So, I mean, if you want to put it into perspective, right? We take that same math. You're talking to break even. It's 140 months.
That's a long time.
Right? I mean, that's 11.6 years to break even. Just on that.
Yeah.
And what's the average time that people stay in a house before moving?
5.5 years.
5.5 to 7 years, right? So,
and you're making a bet, right? You're making a bet that rates will not drop in that time. And when you go refinance, it's going to cost you money to refinance anyways. Mm-hmm. So what we're saying is, and my dad told me this every time I went to a casino when I first started gambling.
Put $20 on black. Oh, wait, no. wrong casino.
That was Entourage.
That was Vegas.
Entourage in Vegas. I
got a story about JC in Vegas later for you guys that want to stay tuned for episode 3.
Just one story? So was it, you know what you know now. You don't know what we don't know in the future. So what he said was, if you're going to go to the casino, take whatever you wanted to take out of your bank to gamble and just assume it's lost.
Yeah. I think it's a great way to describe it.
For me, it was always $200.
Right.
I'm okay losing the $200, but I had fun for 7 hours. Cool.
It's cost benefit analysis, right?
Yes. If I win, I win. If I lose, I already knew I lost.
Did I have fun? Did I have more fun than I had not fun losing money?
100%.
Yeah.
So now with the permanent buy down, which we just talked about, if you go to like a 2-1 buy down or a 3-2-1 buy down, here's how it works. So a 3-2-1 buy down, which is a newer program for a lot of these lenders out there, is, let's say today's rate's 7.125,
which it is. Oh, it was as of an hour ago.
Yeah. You take 3% off that 7%,
mm-hmm.
which brings you down to a 4125.
Yep.
So on a current listing we have, which is $600,000.
So this is a real world example. I know a lot of people will throw out numbers and figures and hypotheticals and whatnot, which is good, right?
Mhm.
But we decided that, I think it's beneficial for anybody listening that if we give them, a specific listing that we physically have in the MLS, it is active, to give you guys an idea of the power of what this would do if you're a potential buyer on this property.
100%. Good thing Oscar's not here because he's not very good at math, but he's really good at pictures and drawing them on paper. So
He can count, like how many shots? 1, 2, 3.
it's
But
true.
after that,
again,
it's a little weird.
His math gets weird too,
Yep.
then, which is awkward. So let's again go back to the example. So $600,000 house,
Yep.
10% down, at today's current rate of 7,125. After insurances and taxes are built in, we're looking at a payment of $4,251.
Okay.
If we did a 3-2-1 buy down in that very first year at a 4.125, the payment drops to $3,200 even.
So what's the difference in that monthly?
It's $1,251,
Okay.
which is basically 2 Teslas.
Easily.
And the second year jumps up to a 5.125, which is 3,553, so
Mhm.
$3,553.
Okay.
Only a $300 a month jump.
Okay.
And then we jump back up to what's normal.
So
Now the cool thing with
year
this is
one, you said you saved how much a month?
$1,000.
Okay. So let's go times 12, right? So you're talking almost $12,000,
Mhm.
right? And then year two
You're saving roughly $750.
per month,
Mhm.
right? So 750. Oops. It's weird on a calculator and a computer. but-
Jameson can't do math in his head.
Yeah, no. Oscar, I'm hearing the same recipes. $9,000,
So what's the total of those two savings?
$21,000.
$21,000 in 2 years. Insane, right?
That's big money.
Yeah.
I mean,
And
divided
then-
by 24 months, you're talking
And then
$875 a month.
on a third year, it goes back up 1%. So now we're at 6,125.
Right, which is where you would have started
Well,
initially.
even 1%.
Actually, no,
more,
1%
yeah,
later. Yeah. Yep.
So now you're talking, you have 3 years to figure out, are we going to drop? And the really cool thing about this is, so there is a cost associated with this, but in most cases, almost all cases, sellers are paying for this cost.
Mhm.
So on a $600,000 house, we're talking roughly $15K.
Yep.
And a house that's been sitting in the market for 45, 61 days, you think they would take $15K to sell this house?
Yes, absolutely.
100%.
I mean, we talk, so just from a realtor standpoint, if I'm listing a house, right, and this is assuming we list it at the right price and we do the comps and we say, hey, this is what it's worth. At the end of the day, what do we always say? A house is worth whatever somebody willing to pay for on any given day, right? Well, if a house is on the market for 21 days, we know that whatever price that is, nobody's willing to pay that. And we've gone so quickly from, last year was 3 to 4 days on market. We're up to 15
No, we're up to 25.
or 25 days.
Yeah.
So at this point, sellers are willing to concede some things to get the house sold so they can pull their equity out, they'll pull the money out, their proceeds, whatever it is, to go to a new place. So if you're looking at that and you say, oh, well, yeah, it's all, the numbers are fine and great. Yeah, the numbers are fantastic. However, the reason we want to use a real world example is because this is what's happening every day in the market. And if you are working with your realtor and this conversation hasn't been brought up, we recommend that you guys have the conversation and get creative. It's not a bad thing, right? We always say it's adapt or die. Like, that's just how it works.
That's life, man.
And in this kind of environment, like, we want to make sure that with our clients, we're having those conversations as a buyer standpoint and from a seller standpoint, which we'll get into a little bit later. We're having those same conversations. But the point is, and the whole reason we're talking to you guys is to make sure you understand that there are creative ways and there's different ways to get into the place that you want to get into with a cheaper monthly payment that a lot of people think is possible right now. Because people just assume 7.125, the freaking sky is falling. I can't afford it, so I'm just not even going to look. And that's not the case.
Yeah, well, you can also take advantage of two things. So at 4.125, is it as good as it was 4 or 5 months ago? No. However, is it at a healthy rate?
Mm-hmm.
Are you also going to get a house that's probably undervalued in some ways? especially now with seasonality and
Yep.
the market trends.
Yeah.
So you can get in there, right? So and the cool thing is it alleviates some of the stress of what people thought about back in 2018 or 2008, 2007 with adjustable rate interest
Right.
rates. So you still have to qualify for this home at the higher rate.
Correct. Yes.
So you still have to be able to afford the payment based on the standards that the government has set up for the debt to income ratios. What they're saying is in the first 3 years, you can take advantage of a lower cost of ownership and hope that within 3 years, the rates will drop below what we think.
Which, if we look historically, we do think is going to happen. And
Yeah.
I think that's the big, you bring up a great point, right? Anytime somebody hears creative financing, they think, okay, all lending practices are out the window. We're just trying to get people in the houses. It's going to be 2008.
It's not 2008.
It's not the case.
There's still government regulations involved. There's still a lot of safety nets. And ultimately, it's going to be a good bet, right? You already know what the highest payment will be possible. You've qualified for it. Again, my analogy back to when my dad said to go to the casino. I knew what money I'm taking to the casino.
Yep.
What I didn't realize was my first 3 years of bets, I didn't have to pay for.
Right.
They were free because it's below what I thought it was.
Playing house money.
Yeah. And so now we transition a little bit into 2-1 buy downs.
Mm-hmm.
What is that one?
So 2-1 buy downs are essentially the same thing as 3-1 buy downs,
Mhm.
right? It's essentially saying, hey, for the first, 3 years or 2 years, you're going to have a lower interest payment. And the concept is the exact same. It's seller concession paid, right? And this is where the strategy comes in when it comes to offering on homes, because any of the buy downs we're talking about has to be paid by the seller.
Yeah. Could be paid by the seller, could be paid by the lender, could be paid by the agent. And this is kind of what separates us apart from a lot of the folks out there
Yes.
is with our relationships we built with lenders, as well as, because of the volume we do and as many agents as we have, like we're not going to like beat up a client
Right.
over like a commission.
No, absolutely not.
So if someone comes up to me and goes like, hey, JC, I want to buy this house,
Right.
but I need like, some help. Guess what? I'm not a selfish person. I'd rather get that person in the house because I'm hoping that I take care of them, and in the future, their family, their friends, their referrals takes care of us. So we set up promotions and collaborations with certain business partners where we can help take care of this burden.
I'll give you a real world example. My last closing, we closed on the 19th of September, I believe. First time home buyer, and I kicked in I think $2,500 in commission
Mm-hmm.
to get him into a house, right? And yeah, it's $2,500, but the point is we're willing to do those type of things because we understand the landscape that we're in, and we understand that it's hard, and we understand that it's stressful. And something like a 2-1 buy down, if we're able to help bridge that gap, right, to give those concessions so that people can get into a home, to me, like that's worth it, right? Like, yes, we do. Real estate agents make good money.
Well, it depends who you talk to. So
We do, right?
Yeah, I mean, like,
but that's not why we do the job, right?
Yeah, well,
Like,
you couldn't be successful
no,
in this business if you did it just for the money.
Mm-mm.
End of story. Like,
Absolutely
it's just not how it works.
No.
So ultimately, we want to make sure that we get you guys into the place you can.
Yep.
With the current products and promotions that are there, and we have the ability to network with the people who we have trusted relationships with, and that's a benefit of working with us. Again, sales pitchy, I get it, but like at the same time, like, hey, could you imagine buying a house today, very minimal money down,
Yep.
getting the rate you want, and in 2, 3, 4, 5 years from now, be able to upgrade or cash out some equity that you never thought was possible?
Well, that's the point, right? Like when we talk about 2-1 buy down, just to go back to what that looks like, right? It's the exact same as a 3-2-1 buy down. It's just a shorter time frame, which normally means it's a little bit cheaper.
Costs a little bit less, yeah.
From a down payment, not down payment, I apologize.
Yeah, on a
concession
$500,000, on a $500,000 loan, not like cost of house, right? Depends on what you're putting down. A 3-2-1 buy down would cost you about $15,000,
which you get from the seller
Mhm.
in concessions.
Yeah, and a 2-1 buy down would cost you right 10.
And the reason that's important too, right? And this is from a strategy standpoint, is depending on the price of the house and how long it's been sitting on the market, it could be that, in your specific scenario, a 2-1 buy down is a more attractive ask than a 3-2-1 buy down. And with a 2-1 buy down, you're still looking at, year one, you're 2% under, right? So 7,125, that puts us at a 5,125, and then a 6,125. And then by year 3, you're back at a 7.125, which is the par rate, but it still gives you the option, and it essentially buys you time to let rates normalize a little bit more to where you then can refinance and get a lower rate for the rest of the 30-year term. And our job is to make sure that these conversations are happening. And again, I reiterate it, right? If you're looking to purchase a home, have these conversations with your realtor. Just do, because there's different options that we're willing to do.
There are tons of opportunity. Point brought up from the last pod. So we're working on vocabulary with the kiddos right now. It's kind of funny. So Legend, he's in second grade. He's reading Charlotte's Web, and
great book.
Yeah, such a great book.
Great book.
And the reason why I bring it up is because he's like all.
I still hate spiders, but good book.
I mean, he's like, Charlotte's probably the best spider in any.
She is. Yeah, she's a G.
She's
a G. Yeah.
But he brought up like words that we were saying and like didn't understand them. The reason why it came up is because like gullible is a.
Oh yeah. Yep.
So when we say concessions, again, weird transition. I said it because he asked me what that meant because we kept saying it. Is concession. Sometimes we don't understand. We haven't quite like defined that term yet. So a concession, what that means is a seller is going to give you a set amount of money that they would receive from the sale of their house. For example, let's say the house is $500,000.
Mm-hmm.
We would pay them $500,000 for that house, but $10,000 of that $500,000 would go towards the buyer's costs.
Mm-hmm.
Meaning they can take that $10,000 and apply it towards closing costs.
Right.
They can apply it towards a rate buy down.
Mm-hmm.
Heck, I've even paid off people's cars.
Yeah,
with this.
I do remember that. Yeah.
So
absolutely.
if you think about it, so $10,000 over the course of 30 years is a lot less expensive because it's like a monthly fee, right? So normal rates, I'm gonna go normal rates here at a 4.25.
Right.
It's like $55 a month.
Right. Yep.
And if you think about it, you're gonna own the house on average 5 to 7 years. So $50 times 12 times 5.
Mm-hmm.
It's a lot less expensive than $6,000.
Yeah.
So what we like to do is use these closing costs / incentives to help our buyers get what they want and help them position themselves better for the long term. So thank you, Legend, for the telling me. First off, he did tell me I banged too much on the table, but also
I did too. I have purposely been almost sitting on my hands this whole time. So
yeah, and thank you
holding
for
a microphone so I don't bang it.
Yeah, thank you, Charlotte's Web and Gullible for making him conscientious of vocabulary. But yes, so
real quick. Yeah. I just want to interject a little bit. Some of you may be out there listening and going, well, why would a seller give me concessions? Why would they give me $10,000 out of their own pocket, essentially, to help me pay for the house that I'm buying? And I think it's an important distinction to make because realistically, if let's say I sell a house or I list a house for $650,000, right? Market value, it's where it's going, but it sits on the market for a certain amount of days. So JC, let me ask you this. If you're listing a house, right, how long do you normally wait until you discuss price reductions?
Depends on a couple factors, but typically if we price it right, I don't touch anything until 21 days.
So 21 days. So let's say you go through 21 days, you have a couple showings, no offers, not a ton of interest, right? At that point, you discuss a price reduction on the for the seller, right? To whatever that looks like, right? And at that point, you pull more comps because now you have 21 days more of market data, so on and so forth.
You got my mind going crazy. I'm like doing the math in my head. Yes.
Right. So here's what people don't necessarily understand because a price reduction and seller concessions seem like two very different concepts.
It's all net to the pocket.
They're not, right? It's net to the seller.
Yeah.
So the seller can either price reduce by 15,000, right? Which at 650 takes it down to 635, right? Or they can say, hey, bring us 650. We'll give $15,000 in concessions, or we'll accept $15,000 in concessions as an offer. And the difference being the monthly payment to the buyer, which to what you just said, right? Yeah. Well, $15,000 over 30 years is nothing.
Yeah. Well, put it this way. So at a $600,000 house, at a 7.125, you could only accept an offer for buyers who could afford $42.51 if they brought 10% down.
Right. Because it's all about monthly
now,
payment.
Like to afford a payment of $42.51, you're talking about making
it's 40% front end, so
$120,000 a year.
Yep.
Now, what if you brought in buyers who could afford $3,200 a month? Does that open up your buyer pool?
Sorry, $160,000 the first time, $120,000 the second. So you're talking a $40,000 decrease in monthly earnings to afford the same house if you do concessions versus a price reduction.
You're just opening up your potential buyer pool.
So I think it's important to distinct, right?
Yeah.
People go, well, why would a seller do this? Well, a seller's going to do it because the net to the seller is the same.
Yeah,
if I price reduce $15,000 versus if I give $15,000 in concession, the amount of money that the seller is going to pocket after that transaction is the exact same. The difference is I can now attract a larger pool of buyers because the affordability changes. Yep. And I think that's a very, very, very good thing to kind of differentiate. And that's why we talk about these seller concessions and what the power is, because at the end of the day, the goal from a seller is to sell the house. Well, to sell the house, you need the biggest buyer pool possible. Concessions can bring that buyer pool.
Are you talking about supply and demand over here? Again.
No.
Economics 101. Supply, demand. More buyers means quicker homes sold.
Exactly.
Especially in this market. And that's where it gets confusing and also can create some ultimately hard decisions to make because you don't know how best to market the place. And again, partnering with a very tenured, very knowledgeable, very creative agent is going to make the difference for you and your family.
Thinking outside the box, man. That's what we do. And the beauty of it is with our team, right? We bounce these ideas off all the time. Like we'll sit down. Heck,
makes it fun.
I'll be honest, right? We've played Call of Duty together. And instead of saying, hey, there's a dude at 127 West, it's, hey, so what do you think about the current market conditions? Like if you're playing with us, it's actually probably pretty boring because we're talking about real estate the whole time. But it's a good thing because we have a very good pulse on what's happening, where the market is. And when we're talking about all these 2-1 buy downs, 3-1 buy downs, creative financing options, the reason we bring it up is because we understand the power that it has for buyers and sellers in this market.
It opens up
based on what your goal is.
It opens up opportunity for both buyer and seller, and that's where our goal is to. Like, it doesn't matter what the rates are today or tomorrow. People need to buy, people need to sell, and our goal is to make sure that we open up as much opportunity for as many people as possible with as many solutions as possible.
So that being said, we're going to touch on something that I think has a very, very negative stigma.
Yep.
And it's because of 2007, 2008.
Mm-hmm.
And I want JC to kind of talk us through what this looks like, because it is something that we are seeing more often, especially in higher priced homes, right? And that is ARMs.
Oh man, ARMs. So what we're going to talk about here now is a subject that a lot of people feel is taboo. But I think, again, like anything else that is scary, there's no education behind it. So when 2008, I keep saying 2008. Yeah, 2008. When 2008, 2007 happened, there was some crazy things happening in the lending practice that are totally gone now today because of regulation and issues that have happened.
Yep.
So the cool thing is a lot of that stuff that was bad has changed.
Yes.
So an ARM basically is this. You get a rate today based on your credit score and what's available. Then it will adjust at a set period, and and it will continue to adjust by a set time frame after that.
Correct. So it's an adjustable rate mortgage. That's what an ARM stands for. For those of you guys that don't know what that looks like, an adjustable rate mortgage really means exactly what it sounds like, right? It is a mortgage that you have at a certain rate that can be adjusted on specific timeframes.
Yes. And for the most part, they have priced themselves out of the market purposefully because of the uncertainty on it. But today, especially in certain buyers' circumstances, they're actually pretty attractive.
Yeah. Yeah.
So we found with our jumbo buyers, so the jumbo today is like anyone 647. It's about to be 715 next year. Meaning
for the kids out there, what is a jumbo?
Jumbo means like there is a certain amount of money you can borrow before you get into non-conforming rates, meaning this is outside of the normal purchase price for most people in that area.
Yeah. Basically, the banks want to lend a certain amount of money, right? And in Douglas County, since that's where we're at, we're around $647,000.
In 2022, in 2023, it'll jump up to like 715. Yep. That's the amount of money you borrow. So let's say you put 5% down add 5% to what we can borrow.
Yep, exactly.
So the
Anything above that is a
jumbo. The cool thing with
not to be confused with Dumbo.
the
but
cool
jumbo.
The cool thing with jumbo and Dumbo is that most of anything jumbo.
This whiskey's working, by the way.
12 years is feeling pretty good. The cool thing with jumbo is they're not beholden to Fannie, Freddie, i.e. government guidelines. These are investors with money who want to lend money to other people to then get the interest.
Right.
So they can kind of come up with their own terms. So some of it's like the old Wild West where there's not like a set standard. So it does help to shop around. But we are getting folks who are getting into jumbo loans, which is above the median price point in most of Denver now.
Yep. Yeah, because I think right now, so for example, right, just for context, I'm going to pull this up real quick, so excuse me. But Castle Rock. We're in Castle Pines. I use Castle Rock all the time. Zip code's 80104. So the median list price in Castle Rock is $665.
Yep.
Currently, jumbo loan is $647, right? So essentially, like JC said, at $665, you'd have to have a certain amount of down payment to get into a conventional conforming loan. If you're buying a house at $800,000 with 3.5% down, most likely you're going to be in a jumbo loan. So that's why we talk about this, because this is where the area that affects. And to JC's point, it's going up next year, right? Which it should, because his home value increased.
Yeah,
but
every year it goes up a little bit. So, but the cool thing is like you have options around like how you use your money. So if I'm at a let's say that like to Jameson's point, I'm buying a $700,000 house.
Mm-hmm.
Why would I put more money down to get into conforming when I can get a jumbo at a lower rate?
Correct.
And right now with the jumbo rate, so a 10-1 arm, what that means is for the first 10 years, your rate will be fixed.
And that's going to depend on the investors.
Yes.
What their rate is. But it's normally cheaper.
It's normally cheaper, yeah.
Yep.
But right now we have some good lenders, some good deals. So for the first 10 years, your rate will be fixed. And then you'll have a 1% one adjustment every year on that loan.
Yep.
Based on current rates. So the crazy thing is at a jumbo 10-1, the current rate is 5.25.
Which right now conventional 7.125, right?
7.125 at Premier Credit. So it's actually cheaper to get a jumbo than it is to get a proper conventional or conforming loan.
Yep.
So if you think about it, like, would you rather save your cash for your down payment,
right,
or go into a jumbo at a lower rate? Where's the return? You have 10 years for it to readjust and to refinance.
Yep. Which again, you're I don't want to say the word gamble, but you are essentially betting on the fact.
It's a gamble. It is. You're making a bet.
The rates are going to go lower
in
which you can refi into a normal conventional mortgage for 30 years, so on and so forth.
Yeah.
Right. But I think the big portion of the point of this is when people talked about ARMs previously, right? They were uncapped. It was Wild West. People were making
they didn't verify income.
Yeah, it was insane. That's not happening.
So
ARMs still exist.
How to qualify for that? What is your debt to income ratio need to be?
Well, it's got to fall within the range of how much that loan can adjust year over year, right? So the beauty of this is you take a risk, and we will say that till the day we die, which is why we have these conversations, right? And again, I'm going to reiterate, if we're not having these conversations with your lender, your realtor, you should, because it gives you more options. And our entire job is to cut through and make this as transparent as possible. But you still have to qualify for what the maximum fluxation, whatever word you want to make up, variation of loans are for that time period, because they're not going to lend you money. Everybody's learned from 2007, 2008 with all the default loans, right? As an investor, think about it. If I'm loaning somebody money, right, I'm going to make sure they qualify because I want to get my money back. And from an ARM standpoint, because they're fueled by investors and banks that have investors, they want to make sure that you as a borrower can qualify to make sure that your debt to income ratio fits within that range. If it's a 1% increase, right, there's also 7/6 ARMs. There's a bunch of different things. And we encourage you to talk to your lender to find out what's best for you. But you do have to qualify on the low end and the high end to get an ARM and to take advantage of the lower interest rate.
Yeah. So they're going to verify that you can afford the highest potential payment based on the threshold of the adjustment. But for 10 years, you get the advantage of the lower rate.
Yep.
And that's why it's not a bad deal, right? So we know that most people own a house between 5 and 7 years.
Correct.
So you may not even refinance. You may just sell the place. So it's actually kind of cool because we're going to transition to that seller piece of it.
Yeah, we didn't forget about you guys. If you're looking to sell your home,
hey,
you're like,
sellers.
why am I listening to this goddamn podcast? These guys are just going on and on and on about buyers. Yeah. No, a real estate transaction has how many parties involved?
There's 4.
There's 4.
Typically.
And sellers are one of them. So
yeah, and one of the biggest pieces.
We'll feed you baby birds. We got you.
And again,
so JC banged.
Oh, I banged. Sorry. Banging over here. So sellers, right? So ultimately, we want you to get to where your next step is. We talked about this last week. It's what we talked about.
The goal is what? Get you to your next place.
Get you to
or whatever that goal is.
Get you to your next step. And I didn't bang. I just touched the table at the time. So the next step is where we want to get to. And depending on your situation, whether it be in a move up, move down, out of state relocation, or just cash out, we want to make sure you get to that next place. So when we sit down and talk about the next step, we're going to discuss the best way to market your home to make it more appealing, more appetizing to as many buyers as possible, because we know that supply demand dictates that the more the buyers, the quicker the home sells for the highest, price band possible. So to do that, we're going to sit down and we're going to discuss, hey, let's say the homes in your neighborhood are selling for $600,000.
Yep.
What if we listed your house for $600,000, but with a 2-1 buy down? Meaning we're going to price in the 2-1 buy down and then advertise what that interest rate will be for that specific buyer.
Which again, all we're doing is people focus on the price point of the home when they should focus on the monthly payment, right?
Yeah, why is that frustrating for us?
It's frustrating for us because it's a misnomer, right? Mm-hmm. People go, well, I can afford $600,000 because I plugged into a mortgage calculator, blah, 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 blah. And it said I can afford $600,000, which sure, right? But at the end of the day, your bills, your finances, your income versus what you spend monthly is going to dictate what you can afford on a monthly basis. So a $600,000 home with a concession is going to adjust the monthly payment on that home, which then brings more buyers in, because if somebody, and we talked about earlier, right? There's a group of buyers that can afford $4,700 a month. There's a larger group of buyers that can afford $3,200 a month. Why would we not want to bring them in?
100%.
Because at the end of the day, it's the psychology of sales, right? If you get more eyeballs on your property as a seller, then what's going to happen?
You'll get more offers.
Right? And even if I am still advertising, hey, I'm going to give you $10,000 in concessions at $650. Let's just say that, right? Well, if I get more buyers looking at my house, then I may take a bid for $670 with $10,000 in concessions, which means the net to my pocket that I can put in my bank account that gets me to the next place is even more.
Yep.
And people focus, and especially sellers, I run into this all the time, right? Sellers look at what I'm going to sell my house for because my neighbor's dog's kids sold their house 3 months ago for something. That doesn't matter. It doesn't matter anymore. We have to adapt or die. That's literally what it is.
Adapt to the current environment.
That's what it is.
And like from a seller standpoint, so we list your house for $600,000. It's going to, let's say it sits for the 14, 21 days. Mm-hmm. People are expecting to get it a little bit off of the list price.
Sure. So psychology.
But if we can market the place saying, hey, $600,000, but at this price, your payment will be $1,000 cheaper.
Yep. How many people are going to flock to that house?
Would you take $1,000 off the price? Would you take normal rates, $15,000 off the price? It's going to give you like $70 off.
Right. Exactly.
What's better, 1,000 or 70?
Especially if that $1,000 is the difference of a 3-bedroom house to a 4-bedroom house, and I'm a family that has 3 kids. Right. That is a massive difference and a massive pool, and that's why, from a seller's perspective, we talk about expectations, and we talked about it last week. It's one of those things where get creative. Like, the purpose is more eyeballs. Seller concessions initially, they seem like a bad thing, but they're not, because they get more people's eyeballs and a larger buyer pool that will allow you to sell your house for even more. And JC's getting so excited about this. He just poured us another shot of the 1792, which, by the way, if you guys remember, pop quiz, first year Kentucky was introduced into the nation as a state. So Yeah, I think that the perspective has to make sure that, like, we understand our job is to get your house sold as a seller. Our job as a buyer's agent is to get you into the place that makes the most sense for you as a monthly payment. And I think what we've talked about today from a creative financing standpoint and different things we can do benefits both sides, right? Is it going to benefit buyers a little bit more? Yes, in the sense that they're going to have more opportunities, right? But from a seller standpoint, getting more eyes on your property means that you're going to have more opportunities to sell your house at a higher price.
Well, again, it comes down to what are you trying to accomplish, whether you're a buyer or seller. There's opportunities in every market.
Correct.
If you're a seller, if you're a buyer.
If you're in Vegas. Wait, what? Sorry.
There's always opportunity. And we are able to set you up with the right strategy that makes sense for you and your family.
And why is that? Because how much experience do we have? We've been doing this for a while. We've had a lot of transactions.
We don't suck at it.
We don't.
We don't suck at it. And we're actually getting, it's crazy. We're getting busier. Like my phone keeps ringing. Things
Dude,
keep happening.
it's a humble brag, right? And I think we take pride in being creative and being transparent. I think that's the biggest thing. Yeah. Like, I will be transparent. If somebody says, hey, I want to list my house here, I don't have a problem.
I had a conversation yesterday. Got a call for a $2 million listing. Mm-hmm. Sat down with the gentleman, discussed kind of what we do and how we operate. And he says, well, I got an offer from this investor with this other competing brokerage. And they said they could pay me for this house. Yep. And I go, great. Here's the deal. Take the meeting, see what they say. Here's what we offer. If it's better, I will tell you it's better, because it doesn't do me any favors to hold onto a listing that's not going to sell. Right. So again,
if you don't sell, you don't get paid. Well, it doesn't matter anyway.
But also, like, you're going to leave with a sour taste in your mouth about me and my team and how we operate, and that's not how we do our business. No. So to transition into our ending of this podcast is buyers. I get it. It's scary. There's a lot of nonsense in the system, and we're trying to figure out like what's right, what's wrong. There is still opportunity. And if you partner with the right agent who understands that where we are in the market and have the great partners with lending that we have, you will win today.
You will. And you want to make sure, like, thinking outside the box is going forward. That's what it's going to take, I think. And I say that because we were spoiled for 2 years, right? Low interest rates. You could buy houses cheap. You could sell houses for as much money as possible. And now we're moving into where it actually takes a strategy. It takes thinking outside the box. It takes transparency, all these different things. So the best thing you can do is, if you're a buyer or a seller, right, make sure the things that we talked about in this episode, make sure you're having those conversations with your agent, whoever you're working with. If it's not for us, cool. That's totally fine. Our job is to arm you with as much knowledge as possible to be as successful as possible in a real estate transaction, whether that's with us or it's with somebody else. We don't care, right? We really don't. No. Because at the end of the day, the more successful the real estate market is, guess what? The more successful we are, the more successful people are, the more money they make, and that's what our entire goal is. So, JC, I'm going to ask you this. We talked about a lot, man. We talked about the whiskey, right? Killer. We talked about 2-1 buy downs, 3-2-1 buy downs, arms. We talked about buyer strategy, seller strategy. So give me your biggest takeaway that we talked about today.
My biggest takeaway is don't be scared. It's going to change. Things are going to shift. They're going to move up. They're going to move down. Take a deep breath. Mm-hmm. Take a sip of bourbon.
Or like 3, depending. If you're on this podcast, at least 3.
3. And figure out what do you want to accomplish. Yeah. And I guarantee you there's opportunity.
Fair. My biggest takeaway is everything, when you talk about a free market, is cyclical. And the best advice I can give anybody is be comfortable with change and adaptation, right? Whether that's a 2-1 buy down now versus, higher offers later versus creative financing options in 6 months. We don't know what's going to happen, right? If you had a crystal ball, would you be here in this office with these gray walls? Hell no.
My walls would be blue.
Right? Mine would be, blue. That's my favorite color. Yeah, I agree. Same. With a giant wall of whiskey, right? Yeah. So the purpose of this and my biggest takeaway is we can't predict the future. But what we can do is we can take previous facts, events, trends, and give those to you guys to make the best decision. Just be open to change and be open to being adaptive and do what's right for you and your family and have the right conversations. And at the end of the day, it's going to work out.
Agreed. Yep. And of course, our favorite part of the end.
Bro, whiskey.
The bourbon.
I'm going to put my laptop away for those of you watching on video. I don't need that for this portion. So we're going to talk about the bourbon.
All right. So I'm going to defer to you first. This is the first time you've got to experience the 12. Yeah.
Okay. Let me put the microphone down real quick. Get the stand.
So we got a feedback on
Hold on. Wait.
Yes.
For anybody that watched that in video.
Yeah, it's not called a, yeah.
We call that a limp dick. And that's exactly what sometimes happens. I'm sorry. Hey, we said explicit. Oh, there he goes again.
Again, as Jameson.
Yeah, we said explicit in this podcast.
His wife has a couple of reasons why she doesn't like this podcast. So, Jameson, tell me in your most stand-up way why you enjoy this bourbon.
I'm a big old-fashioned guy.
Yeah. Right?
And I love old-fashions. In any restaurant I go to, Charlie, you know this, right? So by the way,
Applebee's does not make a good old-fashioned.
Hold on, quick background. Charlie was a bartender for a while, but he was a cocktail master. And this dude has given me multiple recipes and ideas for cocktails, specifically around whiskey. So I defer to him anytime. If I say I had a good, old-fashioned at this restaurant, I'm about to send him to those restaurants to validate my claims. I judge whiskey based on, do I think it's going to be a good old-fashioned? This 1792 right here, 100%. It kind of drinks like a rye, I think.
Oh, really?
A little bit. It's a little bit drier.
It's weird.
But I think in an old-fashioned, it would be absolutely fantastic. I would say, what do we say? 5 rocks is worst. 0 rocks is best.
10 rocks.
Or sorry, 10 rocks is worst. 0 rocks is best.
I thought that my joke around them getting confused on what rocks was what rocks would take multiple episodes. It took 2.
Yeah, it took 2. All right, so I'm gonna go. Man, I'm gonna go 2 rocks.
Yeah, dude.
I think it's fantastic. I can sip this all day long.
Yeah, this is gonna go up at the 1 rockish rating for me. This is up there with the Pappy 12-year.
Okay.
Or I should say Van Winkle 10-year.
So we did. So we said it, right?
Yeah.
I think on our board. By the way, we have a board to keep us on topic.
I wish this was a little...
Be honest. I'll break the fourth wall. I don't care. We did say that it was supposed to be a worthy adversary to Pappy. JC just confirmed it.
Yeah, I think the Van Winkle 12-year Lot B, this is right up there with it. Weller 12, right? All that stuff. It's fantastic. Easy drinker. I wish it was a little spicier. Like I wish I had a little bit more kick.
Yeah.
I get a lot of hazelnut. I get some vanilla.
I get some blackberry and some black pepper.
Black pepper.
A little bit. I do get a little bit of black pepper.
What did you have for lunch today?
I get black pepper. I do. I'm just saying I do. That's what I get.
You got that blackened chicken.
Yeah.
Yes. Fantastic. I think, again, the hard part with this one is it's not an easy bourbon to find. It's allocated highly selective in areas but I do think if you find this one, go get it. 1792 has a whole series. They make a small batch, which is very easy to find. It's like $29. Again, small batch.
How much does this retail?
This one retails for $50.
So if you take it up against other $50 bourbons.
That's not fair.
Dude.
Secondary on this one's like $250.
I think it's great.
Yeah.
I mean, for the price, fantastic.
No, it's a good one. So, hey, again, thank you guys so much for joining us.
Yep, appreciate it, guys.
I hope this was a little bit less crazy and more enjoyable to listen to. We'll get better. Keep sending us topics. Keep sending us information and feedback around what you want to hear. And I cannot wait to finish my last sip of this fantastic bourbon.
Yep.
Cheers, Mama.
I agree. Well, cheers.
Thank you, Charlie.
Appreciate it. Charlie, as always.
Hey, this is for Oscar in San Diego on the beach.
Exactly. And yeah, guys, send us topics. What you guys want us to talk about.
Forgot to say, if you want to reach Jameson, how do I get a hold of you?
Man, I mean, you can show up my address, but it'd be a little weird. So we're going to go cell phone, 720-584-3361. And Jameson at metro5280.com if you guys prefer email. Otherwise, that Colorado Realtor guy on Instagram, TikTok, and Facebook.
Very good. My name is JC Ortega again. You can reach me at 720-317-9437 or JC at metro5280.com. Guys, cheers so much. Cheers so much to the weekend.
It is Thursday, right?
Yep.
Thursday, Thursday?
Yep.
Appreciate it, guys. Thanks for watching. Thanks for listening. And have a great weekend.